anything over 80% with most banks typically revolves loan mortgage insurance. Okay, so you pay the bank, you set up fees for the mortgage, you pay them the interest, and then separate to that, you have an insurance policy that you need to pay to a loan mortgage insurance company. So that is an insurance policy that is then issued by that insurance company that the bank then takes out. You pay for the privilege, you pay the insurance policy, but it is guaranteeing to the bank that if you default on the loan and the property is not sold for the remaining loan amount and the bank cannot recover their funds, then the loan mortgage insurer will cover the shortfall. All right? So it is an extremely profitable insurance policy. Let me tell you that. Okay? If they're charging you $7,000 or $8,000 for LMI on a $400,000 loan, you look at the chances of defaults across the country, you know, we're talking 1 or 2% default rate. And then most of the time when there is a default, the bank can usually sell the property for the amount of the loan. The higher the loan outstanding, the higher the LVR, the less likely the bank is to recover their capital. And that's when the LMI would come in and cover the shortfall. It might only be 3 or 4%. So you can imagine when they are charging, you know, 1 or 2% LMI on every single 90% loan, it's a very profitable exercise for the loan mortgage insurers. Right? That's a side note. But that's what it is. So when loan to value ratios, when the amount that the bank is putting in the loan versus the value of the property is above 80%, we generally have loan mortgage insurance to be paid. In reality, there are no benefits for paying that. There are no benefits for getting the higher LVR, okay, apart from preserving your capital. It might mean if you've got $200,000 in the bank, you might be able to buy 2 $400,000 investments and not one. That then means that you've got 2 assets that are potentially growing in value. You've pushed your capital, your equity, your cash across multiple deals, and then you're exposing those assets to capital growth or positive cash flow. And that positive growth or positive cash flow is more than the LMI you're paying. So that is a scenario when you're really on the fast track, you're wanting to accumulate, where the benefits outweigh the negatives. The profit that you get from the extra capital allocation, the extra properties, the extra assets is greater than the cost of the loan mortgage insurance. That is a scenario when it is, you know, potentially viable to consider a higher LVR and pay the LMI. It's the cost of doing business. Whether it comes down to your personal preferences or not, are you comfortable with that extra expense? Are you comfortable with that extra loan valued ratio? For me personally, I was. Generally, for me, it was normal business to pay LMI and to get the highest LVR possible when I was accumulating. I get more confidence when I can go out and I can renovate on a property, or I know it's going to be positive cash flow, or I think I've negotiated a good deal, purchased it under market. I have profit in that property. Very quickly, that profit in that property, it's, you know, negates or cancels out or, you know, dwarfs the LMI that I pay. It's the cost of doing business, but the profit is usually greater. In those scenarios, LMI might be a good idea.